My name is Mike Sullivan. Welcome to my YouTube channel. I'm a former IRS agent. I was a teaching instructor, worked about 10,000 cases or so. Welcome to my YouTube channel. My YouTubes are short, they're friendly, they're to the point, and say hi to my M&M man back there. By the way, it's loaded with about 12 pounds of candy. Anyway, there's a reason you do not give IRS a financial statement, a 433A or a 433F. As a former IRS agent, if you have not shown that to a professional, you're probably going to have a real bad hair day. That is speaking as a former IRS agent, which I'm obviously not now. IRS is going to look at to tear you apart. They're going to look at the first page for anything that's unusual, all those check marks on the first page, or your beneficiary, a trust, you transfer money. IRS is going to look at those. They're going to look at your bank accounts. You're giving them an idea where you bank at. They're going to ask for those bank statements. They're going to look at for values of your house, your cars, how much you're paying. IRS is just thinking, what can the taxpayer liquidate, okay, that I can go ahead and collect. They're really looking for fair market values. Are they wholesale values or fair market values? But where IRS does the most damage is page 4 on your financial statement, and that is income and expenses. IRS is really going to scrutinize that. They're going to want to look at the last 3, 6, 9 months or the last year worth of bank statements to make sure what you're telling them is the truth. What they're going to dig deeply into are the expenses listed on the 433A page 4. If you notice, there's your allowable expenses and there's what you think IRS is going to allow. There's actually 2 columns. The only side of that that's important is what IRS is allowing. You need to understand for sections 1, 2, and 3, or items 1, 2, and 3 on the expense side, there are national, regional, and localized standards that they're going to allow. What many people consider necessary and reasonable, IRS just does not, and that's where you get really busted up bad by the IRS. So before you're thinking of talking to the IRS, until you know those standardized formulas that IRS uses on the expense side, it is going to be very bad. So you may be making $6,000 a month, and you may have $7,000 in expenses. The problem is IRS is going to stick to those standards they allow only, and maybe they're only going to allow you $4,000 a month, leaving $2,000 a month left over. If you do want to do this by yourself, which I wouldn't suggest, contact your accountant, CPA, tax professional, attorney, whatever, or us. You really got to know the national standards, because that's where they make hay. You may wind up with a payment agreement that you can't afford because you didn't understand the program and the system. So talk to somebody, get free consultations, whatever. Know that financial statement and know IRS's objective before you give it to them. And remember, IRS is going to want it completely documented with canceled checks, pay stubs, and every expense that you're paying on a monthly basis. Thank you. Give my M&M mans a thumbs up too.